to Business Morning here on Channels Television. It's just a couple of days since we had that decision from the MPC, a 50 basis point cut on the MPR to the joy of the real sector. And of course, the commercial banks also had 50% cut off from the CRL. Now, the countdown to March 2026 is still on. The governor of the Central Bank of Nigeria, during that meeting, the MPC meeting, announced that 14 banks have already scaled through on the recapitalization exercise. So now they have perhaps a better environment after that cut, 50% on CRL and 50 basis points on MPR for commercial banks. And we expect that, of course, to drive down to the real sector and reduce the cost of borrowing. But how will this affect the banks themselves, their operations and their health? We have Ngozi Odum, Research Associate with Cardinal Stone, joining us virtually for this conversation. Hi, Ngozi, good morning and welcome to the program.
Hi, good morning.
So there at Cardinal Stone, were you expecting this 50 basis point cut?
Yes, we largely expected a possible rate cut of 50 basis points, and that was what happened. So it was largely expected.
Oh, okay, that's nice. Now, talking about the banks, we've seen results before now, before that rate cuts. The results look better than what they were last year. Last year, we saw a lot of losses. For instance, we saw for Zenith Bank, their first half 2025 earnings per share went up. Loans and advances to customers increase. We expect it to increase even more now that the CRL has been reduced and cost of funding should reduce. Cash and cash equivalent also went up more than 13%. Total assets for the first half of this year went up. Customers' deposit also went up. Also, for the first half, they do have some positives and negatives. For their gross earnings was in the negative year on year. Interest income up more than 31%. Net income up. We have Stanbic also, Stanbic IBTC for the first half. So interest income up and all of that. So we see positives for the first half. But with this cuts in CRL and MPR, how do we expect it to affect the results for the second half, or at least for the final quarter of the year?
So if you take a look at the results that we've seen so far, I think something that is quite similar is that core earnings, which is really directly linked to interest income, was quite robust for all of the banks. You see them recording material double-digit growth in that line item. And I think that was really instrumental for, will I say, supporting banks' results for H1. As we come into H2 with the 50 basis rate cut, interestingly, in the secondary market, there has been, will I say, a repricing of assets with the expectation for a possible rate cut. So we don't think it's going to be that material. We're expecting that there could be a possible slowdown in earnings, but also you have to know that these banks too have also grown their interest earning asset base. So that's also going to provide some support in the later half of this year. We think that where we'll begin to see some material slowdown will be into 2026. Our expectations are still broadly positive for the second half. And then also, if you consider the amount of rate cuts, it was not quite significant, 50 basis points to really, will I say, impact the earnings we've seen. So there's a possibility that we'll begin to see some slowdown, but we don't think it will be as material in the second half.
But I mean, you said 50 basis points, not so much. I mean, some people will argue otherwise, because some people were even looking forward to at least 25%. I mean, 25 basis points. You know, so 50 basis points for them is even a good one. But do you see this at the beginning of an easing cycle, or do you think it's just perhaps a temporal thing?
Yes, it possible signals a potential easing cycle. If you look at the macroeconomic fundamentals for Nigeria, you're seeing that there has been robust improvements. Inflation is easing. We're now we've recorded surplus, and also our reserves are growing. And then also, if you look at global economies, you've also seen similar rate cuts. So it signals a potential easing in the cycle. But like I mentioned, this easing is coming, will I say, at the later part of this year. So if you look at H2, we've already recorded at least the first 2 months in H2. So the possible rate cuts will be tamer for this year. We expect more of the material impact to come in into 2026, where we'll begin to see more significant slowdown in earnings from interest income line items.
Okay, so the banks are racing towards, and we know that some of the big banks, like the ones we mentioned, the Zenith and the Stanbic, and they don't have a lot of problems. But what changes do you expect as you are projecting the easing cycle to start? What do you expect from the banks, the health of the banks, the operation, especially as they race towards that March 2026?
I think that generally the banks are in a strong, healthy position, especially with the CBN's directive to exit forbearance. I think they are in a stronger financial position. Also, in terms of the health of the bank, in terms of their credit risk access, I think they also put them in a stronger position. So for the banks that are yet to meet the requirements, a lot of processes and, strategies have already been implemented to meet the deadline. And I think they are working towards that. I think with the easing, it also, puts them in a better position to reach these goals in terms of coming into the market and then seeking for funds. But I know that there have been a lot of processes, and thankfully, within the banks that we cover, three of the big banks have already met their requirements, so which is a positive. I think that there is a significant expectation that they will be able to meet their requirements before March 2026.
So what can we expect more? I mean, the real sector, they're just happy about this cut because they feel that there should be more money going to their sector. Do you see that? Do you see the banks able to increase lending with this lower interest rate?
Yes, I think it would incentivize people to come in to also seek lending. At this rate, it's still, high for the private sector, but with the possible signal for potential additional rate cuts, yes, is a great one. And then this could also incentivize real creation, especially in the private sector, manufacturing especially. But I think what banks will also be trying to gauge is to balance the risk-off trade-off, creating credit while also managing their credit risk. So those are the things that will be considered. So obviously, with lower interest rates, it means that borrowers are more likely to be able to repay. So that's also a positive signal for credit creation in the long term.
And I guess we should also expect more profitability from the banks for the second half.
Yes, we can expect more profitability for them in the second half. Most banks have recorded, significant increase, like I mentioned, in their first half. So even if we expect a possible slowdown in H2, their core earnings, which was quite robust in H1, will also provide that support. And also we begin to see better traction in fee-based income and their non-interest revenue line item, which is also a positive. Also, with more people coming into the financial sector and also transaction volumes increasing, this is also a positive into the later part of the year.
And but they always talk about lag when it comes to policies. So yes, we see this cut now, and hopefully we will see in the next meeting, which is in 2 months. How much time do you think we need before we actually see the impact of these cuts in interest rates and the CR out? So that's also important. How much time do you think we need before we see that translate into more economic activities for the manufacturers especially?
So it is slow and gradual. It's slow and gradual. It is not, with a stroke of a wand that it will happen. It's slow and gradual. For the rate cut MPR, there's a minimum threshold set by the CBN of 30% MPR for minimum deposits. So that will be applied. Also, when you come into the system, obviously is the risk based on each bank and their risk management framework that will determine the rates that they give you for lending out. But this is a guidance, right? So the implementation will be gradual. Yeah, so we do expect to see that coming. And I also mentioned, will be more gradual into H2, so you might not see the materiality of it on its books, but it will become more evident as we enter into 2026.
What can investors in banking stocks expect? You know, I mean, we see the markets these days, that hasn't been so vibrant. And then what's your outlook for earnings?
I think our outlook for banks' earnings is that we came from, will I say, a volatile time where we had the FX impact and then the impact on FX-induced gains for banks' earnings. And now we've also seen CBN directives to exit forbearance. I think what we're expecting is that going into 2026, we're beginning to see a normalization in earnings, an earnings base that is not really characterized by FX-induced gains, a more resilient balance sheet because banks have exited their forbearances or are in line to exit their forbearances based on CBN directives. So that puts banks in a better position. Is there some expectation that we'll begin to see some slowdown in earnings? That is also could be a possibility, especially as interest rate cuts become more prominent. But we think that the health of the bank is still very resilient, and that is what we'll be seeing going into 2026, a more normalized bank earnings that is devoid of, will I say, volatilities or one-off income line items.
All right, thank you so much, Ngozi Odum, Research Associate with Cardinal Stone. Thank you for your time.
Thank you.